Can you imagine working 80 hours a week on Wall Street surrounded by experts who are breaking their heads trying to beat the S&P 500? Well, surprisingly, more than 90% of those professionals fail to outperform this index in the long run. What does this mean for you and me? It basically means that the S&P 500 is not only a key indicator of the US economy, but also one of the best places where we can invest our money. However, a common question always comes up: how can I invest in the S&P 500? And clearly, the easiest way is through ETFs or exchange-traded funds, but from there another question arises: what is the best ETF to invest in the S&P 500? And with so many options on the market, it's easy to get confused and not know where to start. That's why in this video, I'm going to show you the main ETFs that track the S&P 500, their key features, and the reasons why you might choose one over another. The best part is that no matter which one you choose, they all aim for the same goal: to mirror as closely as possible the performance of the 500 largest companies in the United States. The great advantage of investing in the S&P 500 is diversification. Having the largest and most established companies in your investment portfolio not only from the US market but also from around the world, since we know that the United States is home to many of the world's largest companies, to reiterate offers significant benefits. However, since there are multiple funds that track the same index, it might seem redundant to buy more than one at the same time. Many people wonder, isn't it better to have several different S&P 500 funds to diversify even more? In reality, if they all replicate exactly the same index, you would just be duplicating your exposure without any additional benefit. So, if the important thing is to choose a single ETF or fund that offers you stability, a good track record, and low fees, we need to consider several key factors. First of all, there are the fees, known as the expense ratio. This percentage, even if it seems minimal, can significantly erode your gains over the years. For example, a fee of 0.09% versus another of 0.02% might seem insignificant today, but after 20 or 30 years, the differences in final returns are astonishing. Secondly, we should pay attention to liquidity and the inception date. An ETF with high trading volumes gives you the ability to buy and sell easily. At the same time, an extensive performance history helps us see how the fund responds during boom periods and times of crisis. Finally, the total amount of assets under management, also widely known as AUM, provides us with crucial insights about the overall scale and the significant level of trust that investors consistently place in that particular and specific investment vehicle. But before breaking down each of the funds and ETFs that track the S&P 500, we should quickly review why this index is so popular and important in the world of investing, so that you're not just investing for the sake of it, but are truly doing so based on knowledge. The S&P 500 brings together 500 leading companies that represent approximately 80% of the US stock market capitalization. This means that with a single investment, you gain access to the potential growth of iconic brands like Apple, Microsoft, Amazon, and many more. These are companies that drive the global economy with their size and influence. History shows us that since its launch in 1957, the S&P 500 has delivered average returns of around 10 to 11% per year over the long term. Of course, this is an average. There are years of big gains and others of declines, but the historical trend has been positive. In fact, many professional traders who try to outperform the index end up falling behind after a few years. We can't invest directly in the index because it's not a financial asset itself, but rather an indicator. To address this, there are mutual funds and ETFs that replicate its components, buying the stocks with the same weighting that each company has within the S&P 500. The main difference between an ETF and a mutual fund or index fund is the way they are traded and their potential tax advantages. An ETF is traded on the stock exchange and can be bought or sold throughout the day, just like a stock, whereas a mutual fund, on the other hand, is only valued once a day after the market closes and is usually not available on all platforms, but rather through the fund manager that created it or brokers that have an agreement with them. Which one is better for you? If your approach is to buy and hold, there really isn't much difference in the long run. However, ETFs tend to be more tax efficient and often have lower fees in some cases. Now, if you prefer the simplicity of a mutual fund and your broker offers it to you without additional costs, that's just as valid. By the way, to be able to invest in these specific ETFs that we're going to be talking about, I'll leave links in the description to the brokers where you can find them, or maybe you'll find direct alternatives to them. So, In the description and in the pinned comment, I'll leave you the links to these brokers. Now then, after talking about all this, we can start with the ETFs. The first on the list is the Vanguard S&P 500 ETF, or by its ticker symbol VOO, one of the most famous worldwide. Why is that? First, because Vanguard was a pioneer in index funds and its founder, John C. Bogle, laid the foundations for passive investing. VOO stands out for its low fee, as we mentioned earlier, also known as the expense ratio, of around 0.03%, and the huge volume of assets under management totaling more than $900 billion. Its liquidity is high and it can be purchased through practically any broker. Historically, VOO has delivered returns very close to the index and pays a dividend of around 1.3 to 1.4% annually, depending on market fluctuations. The second is the SPDR S&P 500 ETF Trust, also known by its ticker SPY. It is the oldest and one of the largest in the world, created in 1993. It has an expense ratio close to 0.09%, which is higher than Vanguard's, but its liquidity is enormous. SPY moves huge amounts of money every day, so investors who trade frequently or do intraday trading prefer it. However, if your plan is to buy and hold for several years, you might benefit more from the lower fees that other alternatives offer. In third place, we have the iShares Core S&P 500, also known by its ticker IVV, offered by BlackRock. IVV also charges very low fees at 0.03% and is the second largest option in terms of size after SPY. On the other hand, it doesn't have the same massive liquidity as SPY, but for a long-term investor who doesn't do daily trading, that shouldn't be a problem. Its returns have been in line with the index as expected, and its dividend is competitive, ranging from 1.2% to 1.4%. The fourth option now among ETFs is the SPDR Portfolio S&P 500 ETF. I know they have quite long names, which is why I'm showing each ETF on the screen. In other words, in this case, its ticker is SPLG. This one belongs to the same family as SPY, but it was created to compete on costs. It has an expense ratio of just 0.02%, which makes it very attractive if you're looking for minimal fees. Additionally, its price per share is lower than that of SPY or VOO, which may be of interest to those who don't have access to buying ETF fractions. Even though it's not as massive as SPY, it still maintains a substantial level of assets, and in terms of returns, it aims to match the S&P 500 just like the others. In summary, which one should you choose? If you're someone who does active trading, SPY is the king of liquidity for getting in and out constantly. Now, if your style is to buy and hold for a long time and you want to minimize fees, the best options are VOO, IVV, or SPLG, since these are excellent. They all track the same index, so their performance charts are almost identical in the long run. The differences arise in cost structure and ease of purchase. That's why you should check with your broker or the platform you use to invest which of these is available for you to invest in. If you have more questions about investing in ETFs or the stock market, leave them in the comment section, and in the future we'll make a video about the questions that come up in this video. See you. Bye bye.